Hey, it's Cashflow Mike, and today I want to talk about how to read a balance sheet like an advisor, not just an accountant. So let's talk about something that most business owners ignore, and most accountants are going to take it for granted. It's called the balance sheet, right? They'll lean on the income statement because that's the report card, right? It's going to tell you how much money you made during any given month, quarter, or year, and then it starts over, right? How does it get to start over, right? That's because the profit or loss at the end of a month, quarter, or year gets put on the balance sheet at the end of that period, right? In the form of retained earnings. That's how they're connected. So let's be honest. It's the most misunderstood financial statement in small business. Owners are scared of it. Accountants gloss over it, and nobody really uses it to make decisions. Most of the time, they'll just look at it and says, oh, those two numbers are supposed to match. I guess my bookkeeper is doing a good job. But there's a lot more that we can do with the balance sheet. First of all, it's the culmination of every decision we've ever made. It is the living history of a company. What you own, what you owe, who owns it, who owns you. Those type of things are all listed on the balance sheet, right? Here's the truth. If you want to deliver some real value as an advisor, then you need to know how to read a balance sheet, not just check off a box, but the spot opportunities. You need to highlight risk and guide the strategy. What are we going to do next? So today we're going to be answering a simple but powerful question. How do I use the balance sheet to have a better conversation with my client? Let's break it down. What the balance sheet actually tells you, first off, it's a snapshot in time, right? It's just a snapshot in time. It's not about what happened over a whole period. It's just what it looks like right now. It's going to answer that question, right? What does the business own? It's going to answer the question that what does it owe? It's also going to answer what's left over for the owners. And here's the big takeaway. It's going to tell you if a business is stable or if it's risky or maybe it's ready to grow. As an advisor, this is gold, right? So I want to talk about 3 words I want you to remove from your vocabulary because nobody understands them. Liquidity, insolvency, and leverage. Even when I ask bankers, sometimes they can't really describe them to me so that the average business owner can understand it, right? Liquidity, basically it's this. Hey, can we cover our short-term debt? It's really just how fast we can convert assets to cash. How fast does this happen? That's liquidity. Also solvency. Solvency is just, can we make our long-term debt payments? If you're solvent, you can make your long-term debt payments. Then leverage is, how are we funding the growth, right? Are we using leverage? How are we funding this thing? So I want you to stop treating these words in the balance sheet like filler because the balance sheet is going to be a signal map for you, right? It's going to be key ratios that you're going to be able to get from this balance sheet that's going to drive your insight. So let's turn that data into decisions. So here are a few key ratios that I use in every advisory conversation. They always seem to come up. The first one's the current ratio, and the formula for that is current assets divided by current liabilities. Really what we're saying is, does this business make enough money to support itself? Can we just generate enough cash to pay our own day-to-day bills? That's really what it's saying. And it's a time period of 12 months. That's what it's used for. Let me just tell you something. If that number is under 1, now everybody can talk about industry average, those type of things, but the basic level, if it's under 1, that's a red flag. If this number is under 1, that's a red flag. That's saying for every dollar you owe, you got less than $1 paid for it. If the number is over 2, and I want you to focus on that number 2, is how much you should have. For every dollar I owe, I've got $2 to pay for it. But for every dollar or so over 2, you have to start asking the other question. Am I using cash properly? Should I be using it to grow? Should I be doing something more with the money that I have in this business? So that's the current ratio, right? Does this company support itself with its own operation? The next one I always look at is debt to equity ratio. Debt to equity ratio is a big fight between the banker and the accountant. How? Well, the banker's trying to give you a loan, the accountant's trying to make you pay less tax, and those are the two opposite sides of this ratio, right? Debt from the banker divided by equity, which is what you pay income tax on, right? The lower the equity, the lower the income tax. But the banker can't give you a loan. So the formula is total liabilities divided by owner's equity. And it's going to measure how leveraged the business is. I want you to remove leverage from your head. That's the formal definition. What it's really saying is, how much do I believe in this company? I believe in it so much and I'm willing to put money into it. I'm willing to take the profit and keep it in there even if I had to pay tax because I'm investing in me. The banker is going to say if this is a bad debt to equity ratio, meaning the number is too high. In this case, you don't want that number to be high. The current ratio, you want it to be high. high debt to equity, you want it to be low, right? Because that means the bank has put in more money than you. The higher the number, the more risk to the bank. So high debt to equity might be okay for a growing company at first, but it's risky if profits are thin. That means most of your money you make your loan payments with profit is going back to the bank. The next one I want you to look at on the balance sheet is working capital. So working capital kind of looks like the current ratio. It's still current assets and current liabilities, except for dividing in the current ratio, we're going to just subtract current assets minus current liabilities. What's left over is your working capital. Your working capital is designed to cover a time period called the financial gap. That's the amount of money we're theoretically, or the amount of time theoretically, you don't have enough money. You're waiting for money to come in and you're still paid all your bills, right? There's a difference between money in and money out. Working capital is supposed to cover that. So what does that mean? First of all, it means, is there a cushion? If this is a positive number, you got the cushion, right, in your business. If it's a negative number, you're not covering anything. This is a super big red flag about you that you're in financial trouble if that's a negative number. And I've got to tell you, the bigger the number, the more positive the number, it means you've got more breathing room, right? If it's a negative number, you need to talk to somebody really fast. So these numbers are going to give you the story, and your job as the advisor is to translate that story back to the client, right? Your Rosetta Stone for business. That's really what you are. So here's some conversation starters from the balance sheet. Here's some ways to get this conversation started. So let's talk about using these insights I just talked about in some real conversations. And I've got a few ways to start a balance sheet discussion with a client. You've grown about 25% this year, but your equity didn't grow at all. Any idea why? Bringing in a lot more sales, but we don't have anything to show for it, right? There's nothing going back to the owners. The other thing is, like, your receivables are up. That means you're growing, but are you collecting fast enough? When you see receivables growing, especially if they're not growing at the same rate as sales, you got to ask yourself, am I getting paid soon enough? Because the longer you wait to get paid, the worse it is for you from your cash position. Another one, right? Inventory's on the balance sheet. So you can say, hey, listen, you got a bunch of inventory, but your cash is tight. Can we rethink about how much we got? Should we count and make sure we got the right amount? We might have too much of something, and we might be able to put some more cash in our pocket by running it down to a more proper level. So these are things that you can gather right from the balance sheet that you can put cash back into your client's pocket pretty fast. Believe it or not, these aren't even confrontational, right? You don't have to be the bad guy in any of these financial conversations with your client. The numbers are the bad guy, not you, right? You're just being curious, and you're there to help the client feel like you're on the same side of the table. Hey, let's look at this together. Maybe we can find some issues that we should be working on together. That's the whole point of this advisory thing. The balance sheet is going to let you shift from bookkeeper or accountant to strategist, because now you're helping them see the hidden story in their numbers, right? You're seeing them, the story's developing, it's all coming to light. I also like to make things visual. In my app, the Clear Path to Cash app, I try to make it simple as possible, simple blocks, bright colors, so you know the difference between what's going on. And most clients don't think in spreadsheets, right? Make it visual. Use month-to-month comparisons. Use some bar charts to show changes in assets and liabilities, not just numbers. A wall of numbers makes people glaze over. Use some visuals to do this. You can even use traffic light indicators, and Excel helps you do a lot of this with conditional formatting. Red, immediate attention. Yellow, make sure we're monitoring this. Use some caution here. And green is we're good to go. It's as easy as creating a color code for them to be able to follow. So you can show them, here's another way. You can show them ratios like a dial, right? Like a dashboard. And in my Clear Path to Cash app, I use a temperature gauge for, below average and above average, right? I show you where you are compared to either your goals or the industry average, right? I've seen it like dials, speedometer dials on a car. That's about the same thing. Give them something they can interpret without needing an accounting degree, because better visuals equals better understanding equals better decisions. Think about that. Better visuals equals better understanding equals better decisions. That's your job as an advisor. So here's the bottom line. If you want to be a real advisor, not just a reporter, then you have to know how to use the balance sheet as a conversation tool, right? Conversation between you and the client to get them to take action. It's not just for banks, and it's not just for taxes. It is an X-ray on the business. That's why I call you the financial doctor, right? So pull it out, run the ratios, ask the questions, make it visual. That's how you're going to get their attention. So I'm Cashflow Mike, and this is how you're going to turn numbers or ratios into action. Let's go out there and help some clients and see, or help them see, what they've been missing. Check out my stuff at cashflowmike.com.